welcome to our knowledge transfer series. Today we're going to be talking about an exciting topic, well, at least exciting to me. I never thought I would say it's exciting to talk about taxes, but clearly I'm in the right industry for myself because this is a topic that's actually near and dear to my heart. So we're going to talk about tax problems and strategies primarily for retirement, though if you're before retirement, I think this is a good topic to look at. And we're going to concentrate on federal and Washington state specifically. Now, as a general reminder, today's presentation is going to be treated general in nature. The reason is when we talk about taxes, everyone's situation can be wildly different. And, in my practice, I always say I'm trying to give people the 95% answer around tax planning, not tax filing. So there's going to be some gaps in the presentation today. But in general, we're going to treat this as general advice. A little bit about myself. I have 17 years in the investment and financial services industry. I run the AAA Washington Retirement Roadmap program out here in Washington State. I own my own practice in downtown Bellevue next to Overlake Hospital. And I'm a graduate of Washington State University. So always feel free to give me a go Cougs. So we're going to talk about today, and I am actually excited to talk about this presentation. We're going to talk about why I created this presentation, a basic tax problem. Then we're going to flip gears and we're talking about attacking your tax brackets, some of the concept. Then we're going to talk about net investment tax, or really the rule, what I call the rule of 250. And then we're going to talk about retirement tax topics, basic ideas that you should know about in retirement that you need to kind of draw on later, basically. So why did I create this presentation today? Why was I actually created this one as a passion project and to talk about taxes. And really the reason I created this presentation today is a problem with the English language. I remember I've had numerous people in my career come into my office and say, I want you to sell this product because of this tax reason. I've had numerous clients tell me, I want to do this strategy because of this tax reason. And taxes is one of those topics that it really gets a lot of buzz. But there's a basic problem with the English language. It actually is a very fundamental basic problem that I run into all the time. And here's the problem. Let's see if you can spot it. Today, you give me $1. In 10 years, I give you 50 cents. And I tell you, after giving you the 50 cents, I saved you the maximum money on taxes that I could. I've actually put you in a way better tax position because that 50 cents is going to have a capital loss, which now you deduct from the rest of your taxes. And you should be happy with me that you gave me $1 and I gave you 50 cents back. Sound like a good deal? So the problem with the English language, we talk about saving money on taxes. Taxes is a part of an equation. It's kind of in the middle because really your end result is how much money you have after paying taxes. Okay, and really, if you really concentrate on what would I have after paying taxes, you would be in a better situation. But in the financial services industry, we like to talk about how we're saving people money on taxes, ignoring the net result because the net result is kind of hard to calculate. And oftentimes we put people in worse situations because of it. Because if I took that same dollar and I grew to $10, I would cause a tax problem for you. You'd have to pay taxes. Because I made you $9. And in an example, I could say, well, the 50 cents that the other person gave you was a way better tax situation. You should want that 50 cent option, not the $9 of gains that I gave you or the $10 bill. Because, the $10 bill, you have to pay taxes, and that's terrible, right? And now, clearly, in this example, you'd want the $10 bill and pay the taxes for almost any situation. But that's the problem when we talk about taxes. It's this English language problem of when we save people money on taxes, we might be ignoring the net result. And when you make a lot of money, you owe a lot of taxes, but you still made a lot of money. So when we talk about trying to do tax strategies, we have to kind of set the baseline of what we're trying to talk about today. What's the problem? And the first basic problem is you got to understand what your current tax situation is. And if I go to the average person and ask them what their current tax situation is, they're like, I don't know. And that's not to say you don't necessarily know, but a lot of people really don't. And so that's why they fall for a lot of tax traps, I would say. And then you gotta go, what are your goals? Because when we talk about tax saving strategies, a lot of times they're not foolproof as in everyone should do it. A lot of times they're very specific to a specific set of goals or circumstances. And then you got to look at how your money and assets are going to grow over the long term because, a lot of tax strategies are going to take a long-term view of something and, how your assets and taxes grow matter here. And then when you talk about the concept of are there reasonable alternatives? Because, you may want to actually just keep status quo and pay taxes. That sometimes for a lot of people is the best scenario, but you don't know if that's the best scenario or you don't know if the reasonable alternatives aren't the best scenario for you if you don't go through this process. Now, what we're talking about today, the other thing is this is tax planning, not tax filing, okay? And tax planning is, oddly enough, what most people want except at tax time, right? At tax time, everyone wants to file their taxes, and that's where a lot of the questions come into play. But most of the time, people want to go, well, what's my long-term process to make good tax decisions, right? And this is less precise, and this is more the realm. There's lots of good accountants out there, but this is more the realm of planning, financial planning specifically, as opposed to tax filing, right? And so, knowing what you're asking for, what you're trying to do, is actually really important when you start talking to different types of financial professionals. And really what I want to talk about today is a couple main topics. And attacking your tax bracket or understanding your tax brackets is probably one of the most important topics when we talk about taxes. And attacking your tax bracket can be hard for a lot of people because you don't know necessarily what your sources of income are, and you don't know how they're being taxed, right? If you earn a paycheck, you probably have earned income, and you're used to filing your taxes and paying attention to that. And interest income is very similar to that. But when we start talking about dividends, capital gains, rental income, unemployment, Social Security, we actually have different tax rules that come into play here that actually can interconnectedly affect other areas on your taxes. And so this is one of the big problems that you got to start running into is you have to start looking at your income in different types of tax buckets and trying to understand how each of these are affected differently. And that's hard because you may not necessarily know to put these into different tax buckets. So here's some basic ideas of tax buckets that you should be able to put your monies into that are all treated a little differently in the tax code. And then once you kind of have these buckets, let's concentrate on the most common one, your income taxes, right? Interest income fits here, money you take from IRAs fits here, and your wages fit here. And this is critical to understand because, a lot of people just don't understand the basics of how this works, right? So remember your standard deduction. Most people today are using their standard deduction, and that's your 0% tax bracket. That's the first amount of money that you can earn that you pay nothing on. Then you start to go down this list, and you pay as you go, right? So you don't pay 22% on all your money once you trigger 22%. You only pay 22% on each dollar over your bracket. It's called your marginal tax rate. Your average tax rate is what you pay across all your money. But your marginal tax rate is the number you pay on the last dollar of taxable income you earn, basically. And when I talk to people, what you really want to do, especially when you're talking about retirement, is attack the 10 to 12% bracket. Because if you attack the 10 to 12% bracket and then you do other strategies once you get past there, you typically put yourself in a fairly tax efficient position over the long term. Because when you go from 12 to 22, that's a pretty significant increase in taxes at that point. 22 to 24, 24 to 32. Once you move up here, you're starting to pay ever increasingly higher tax burdens. And if you could do other strategies to avoid going from 12 to 22, that's where your first baseline decision point is. Can you do that? And this could be pretty significant income. This is $5,000 a month for a single person in the 12% tax bracket when we talk about your standard deduction plus the top of the bracket. This is over roughly $120,000 for a couple in the 12% bracket before you go over. So it's pretty significant income for middle America we're talking about here when you start attacking your tax bracket. So in general, you want to hit the 10 and 12% bracket. You want to maximize these however you do it. Maybe you do Roth conversions, meaning you take money out of qualified accounts, pay the taxes, convert it to Roth. Maybe you take money out and put it into capital gains or taxable accounts, depending upon your situation. Maybe you harvest capital gains. But what you're really trying to do is you're trying to maximize this situation to the best of your ability to push to maximize this bucket. Then you want to start layering on, if you can. And this is where you layer on savings or things like capital gains. Now, I mentioned I'm in Bellevue, which is kind of at the heart of tech country out here in Washington State. So I have lots of people I work with who have Microsoft stock, Google or Meta stock, Costco stock, Boeing stock, Starbucks. I mean, there's a lot of Fortune 500 companies actually out here. And what happens is as you accumulate this stock, you kind of have this weird tax bomb, which is okay because you made a lot of money, where if you take the money out or reposition it, you can start to trigger taxes. But this actually has a 0% tax bracket. You can take up to the amounts you see here, and this is based on AGI, as 0% tax rate. You can also layer on. So once you maximize your 12% tax bracket, instead of going to 22%, you can layer on capital gains at 15% and put yourself in a more efficient tax situation in the short term. Okay, and so what you're going to find is that capital gains, as long as you're staying under certain limits, which we'll talk about, it can be a very effective way, or cash or other asset classes can be a very effective way to attack your tax brackets. Now, I always tell people, capital gains are based upon AGI. That's how your rates are calculated. But I always say it's easier to think of this as an order of operations. And here's what I mean by that. So income here is going to be in your AGI as well. What I would suggest is calculate this first, then figure out where you are on the capital gain side of the equation when you're attacking your tax brackets. If you do it that way, you're mostly going to be in pretty good shape. It's not a 100% precise calculation, but it's a really good way to look at it, I think, for the average person if you're quickly doing, paper on the back of the napkin math. Do it more as an order of operation. So fill up your income taxes first, then flip over the capital gain side. But every situation is different, and maybe attacking the tax brackets for you is to try and hit, trying to maximize the 0% capital gains for yourself in the short term. Go for the step up in basis later in life where you pass away. Once you get past the 0% gains here, and those gains get wiped out essentially forever. And then aiming the 15% once you get over your 12% bracket. But think about this. Then once again, you may not have the assets to do this, but you can take out potentially up to $250,000, and on this side of it pay 10 to 12%, and on this side of it pay roughly 15%. And most people, if you can actually live on $250,000, if they've ever made that amount of money in their lifetime, would notice that that's a way lower tax rate than you ever paid for yourself. So when we talk about tax bracket planning, it's all about understanding, where your marginal rates are and where your average rates are. And, this is for a single person. What I always point out to people is that when you get into retirement, when you defer taxes in the future, if you're middle America, if you're average middle America, you're typically better to defer taxes in the future. There's always different situations. But the reason is because when you're in retirement, when you're going through this, as a single person living on $100,000 a year, your average tax rate is typically fairly low. And we're talking federal taxes. Ignore property taxes for now. That's a really annoying thing you have to deal with. But your average rate's pretty low. And on the first column here, I have $100,000 pre-tax. That's IRA or 401k money. It's coming out 100% taxable. And you'll notice that you're at roughly a 14% average tax rate. That's actually pretty good when you look at historical norms, if you look at your working years, things of that nature. You're getting to access more of your money there than typically out of your paycheck during your working years. Some other things that you want to notice when you look at the screen here. 22%. That's your marginal rate. Every additional decision, you want to buy a car, you want to take money out of, an IRA to pay for siding or a roof on your house. You need to help a kid out. Those are all done at 22%, right? So what you're going to find is that once you maximize your tax brackets, then you kind of need more analysis of, well, where's the next best place to take money from and why? Because it starts to get increasingly more expensive to access your money. Okay, so the 22% bracket. Now, the other side of the equation is once you start layering income, you're going to run into two different things that come into play. And I'm going to switch over to the couple side because the couple side for almost the exact same scenario is even prettier, frankly. But I always have this concept of, is it enough for you to get out of bed? And here's what I mean by that. I have a standard couples situation where they're living on $100,000 a year. One person is layering Social Security with their 401k. The other person is taking $100,000 out pre-tax, like from their 401k. And the person on the right is paying about $2,000 less in taxes a year. And that's pretty good. And their marginal tax rate is 12%. Their average tax rate is 5.8%. But just because of the way Social Security interacts with you, it's a good situation for you. And it should once again reinforce taxes tend to be lower for retirees on income. We're not talking about property taxes, but income it typically is lower. And so you'll notice here that that's a $2,000 savings. Is that enough for you to get out of bed in the morning, right? It's not. Sometimes you can actually calculate your taxes like this and go, no, I understand that number there, $2,000. It's a good number for me to understand, but I actually want to take out the money on the other equation because I'm trying to draw that money down faster to improve my estate on the back end, right? That's your goals changing your situation. Or I just don't want to do the work. This is really helpful, John. I see them paying an average of 8% taxes roughly in retirement. Great. That's all you need to know. And so, just because you're going to save money on taxes doesn't mean it's enough for you to do something, right? But this is a good example here of how layering taxes can be, different tax strategies can actually save you decent money. And this is just a simple decision of, when do you take Social Security versus not, and the effect that Social Security will have on your overall tax brackets when you attack it. And even if you're going to make significantly more in retirement, okay? And in this example here, I have someone who's living on more money, actually, $300,000 a year in retirement. And I have clients who live on this situation. We can all understand that certain people are going to be able to live on this in retirement. It usually indicates a fairly robust asset base, $5 million or more typically to hit this. But even those people, and they never believe this, you're typically paying less in taxes in retirement than you understand. Because if you can take out $300,000 in taxable income in retirement when you're 67, you typically were earning more than that during your working years, and you were paying a lot more in taxes. And you don't realize that your average tax rate could be so much lower. But this is where layering really matters, because now you're in the 24% bracket, and when you're in the 24% bracket, every additional decision, every additional dollar is going to be taxed at a higher rate, and you might even hit the 32. And this is where the layering in capital gains, personal savings, maybe you're one of those people who bought a life insurance policy in the past, have rental incomes, things that are more tax advantaged. This is where the layering of your taxes can be really good for someone. And so this is an example of people don't realize they're typically paying less in taxes in retirement, but also you can, by layering your taxes, potentially save roughly $10,000 in taxes as an example. That's usually enough for someone to get out of bed in the morning. $10,000. So, considerations for tax bracket planning. Once again, to remind you, can you identify your sources of income? How much room do you have in your tax brackets? Do you understand how capital gains rates or AGI affects different areas of your tax code? Can you avoid saving money on taxes while ignoring the overall net result? Because sometimes you just want to make a whole bunch of money and pay a whole bunch in taxes, and that's okay. And is the tax savings worth the work? Because, a lot of times people will claim, I can save you $10,000 on your taxes, but once you do the math behind the scenes, it's really $1,000 of actual savings behind the scenes. Is that worth the work to you? Especially if you're paying fees to do it. And then I want to talk about this other concept, the rule of 250. This is something that I try and point out to people, and it involves net investment tax and currently Washington state capital gains tax. And the rule of 250 is a concept I put out there that once you get above this amount of income in retirement in your working years, you got to start watching out that you're paying bonus taxes, okay? And what happens here is that first we got to talk about something called net investment tax. This came with the Affordable Care Act. And I always call it the rule of 250 because it aligns really well with Washington State's capital gains tax. But if you're single, it's actually the rule of 200 in this one example. But it's an additional 3.8% tax that you start to have to pay on interest, dividends, capital gains, rental, royalty income, and even non-qualified annuities. So not a lot of financial practitioners know that little piece there. And it's based upon your modified adjusted gross income. Okay, so it's a MAGI calculation, not even an AGI, but it's a MAGI calculation. So there's some components that are going to be added back in, like potentially Social Security. And it's an extra 3.8% you got to pay on your taxes. It's a bonus tax. And so what I always tell people is that if you're going to get above $250,000 of income, you got to start fine-tuning your situation, right? And it's can you avoid something like this? And then in Washington State, and we're going to see what happens later this year because this might be repealed, but there's currently a 7% tax on the sale of long-term capital assets, such as stocks, bonds, things like that. And, we have a lot of people who earn, as part of their income, taxes or create taxes based upon restricted stock units, which get hit by this during people's working year all the time. And once again, you notice $250,000 here, right? And so what I always try and point out to people is if you're getting above $250,000, you need to start watching out for these taxes because you might start triggering them depending upon exactly your sources of income and how they're coming in here. And that's an extra 10.8% in taxes in Washington State here. That's starting to make that capital gains bucket look a lot like the income tax bucket. In fact, there are situations where the income tax bucket now is better than the capital gains bucket. And so, it actually changed fundamentally here in Washington State a little bit of how we look at taxes and tax considerations when we're talking about capital gains taxes. And I call it the rule of 250. It's something you got to watch out for. And this is something that actually people trigger a surprising amount here. First off, your average tech worker who's earning their restricted stock units is triggering this just because of their income amount on top of how much they're earning there. But really what we're trying to do is we're talking about, can you spread out gains? What's your plan to spread out gains on different types of large investments to protect you. Okay. And let's use real estate as an example. Classic situation here in Bellevue where someone buys a piece of property. They bought it, 30 years ago for $300,000 and it's worth $1.5 million or more now, right? That happened here in this state. And, when you go to sell it, especially if it's a rental property, you have to worry about capital gains rates. And you're usually going to be closer to 20% for the majority of the money. You also, because it's a rental property now, you're probably going to trigger net investment tax. That's an extra 3.8%. You also have something called depreciation recapture, because rental properties, one of the reasons it's so tax advantaged is you get depreciation on the income that you get to deduct. And when you sell it, you actually have that depreciation recapture that occurs, which adds taxes back in. And then in certain states, you actually have additional state taxes, though not so far in Washington state, outside of local taxes. And so you have all this that gets hit on your rental property, and you can actually seriously erode the value of your property or your income base, potentially, if you sell it. And that could be a really big problem for people. In fact, I always have a joke with rental properties. They're an amazing investment most of the time, but it's like a marriage. If you can keep it until death do you part, it's really good. If you get divorced from your rental property, it can be a little painful here, right? And so when we talk about net investment tax, it can be really hard to spread out the gains on rental properties. And so when we talk about real estate investments, and we talk about spreading out gains, you got to know about how the sale works. You got to know how the step-up in basis works, i.e. you die with it. That one big tax advantage you have, how's that going to work? Because a lot of people should try and keep their rental properties till they die. You can 1031 exchange it to other rental properties. A lot of real estate professionals are very familiar with this. You can 1031 exchange it to a Delaware statutory trust, which are really investment vehicles done by investment advisors like me that get the money out. It's a way to defer the taxes. So you can actually transfer the value of your property basically as is, and you avoid the initial depreciation recapture, the capital gains hit, and now it's in this DST where you can now generate income off of it, usually using REITs or REIT-like vehicles. And then you keep the property as long as you can. You defer as much as the taxes until you die. But now you no longer have to upkeep the property. It's in an investment vehicle as opposed to a physical piece of property. A lot of families look at installment sales, i.e. spreading out the gains over years, especially around families. If you're single, you probably want to start looking at charitable remainder trusts if you're trying to get rid of your rental properties. And then, I don't deal with this very often actually at all, but there's qualified opportunity zones set up in almost every state that you can flip rental properties to avoid some of the taxation, right? But this is all to help avoid the 3.8% net investment tax and the big capital gains hit, depreciation recapture. And as you go through this grid here, you might go, well, it's not worth it. $100,000 of tax savings is not worth it to me. I really just sell it and move on because I'm tired and I don't want to deal with this anymore. Not crazy. Now, stock sales is another situation I run into a lot. I deal with a lot of retirees from Microsoft who have built millions of dollars of Microsoft stock. And I always point out to them, there was a time in the 90s, in fact, you might have been working at Microsoft in the 90s, where Microsoft stock was kind of not doing very well. It was kind of basically not growing whatsoever. And you may want to consider just diversifying from that in some fashion. But when you diversify from Microsoft stock or really any big stock position, you have this rule of 250 where if you go above it, you might start triggering 7% Washington state capital gains, net investment taxes, 20% federal capital gains, and now you're at 30.8% taxation on that money if you do it wrong. And 30.8% is a big tax hit, right? And so what you really want to do when we're talking about concentrated stock positions is, can you spread it out over time, right? Because 30.8% is enough taxation that potentially even paying fees to get to a lower tax rate can be actually pretty advantageous. Because if you can get it back down to 15%, if you follow specific strategies, a 15% saving on $100,000 of capital gain, it's $15,000. That's pretty good, and that's where you want to spread it out. Once again, charitable remainder trusts are a way, especially for people who aren't going to necessarily leave it to kids. They want to leave it to charity someday. And don't forget, when you die with stock, you get the step-up in basis oftentimes, which could be an estate tax issue, but not a capital gains tax issue. So what I've done so far is I've talked about basic overall attacking your tax brackets, watching out for net investment tax and Washington state capital gains tax, i.e. what I call the rule of 250, and just kind of understanding how some of the interactions of your tax brackets work, and is it even worth it to do the work? But let's talk about how taxes change for retirees, because there's some retirement tax topics we got to go over here. And I kind of made a list of everything. I was like, well, this is everything I talk about. And then I was like, the video is going to be too long here. So we're not going to cover everything here, but we're going to cover a lot of different things. First, we're going to talk about Social Security taxes. And then I want to talk about how the large standard deduction, which I'll just briefly mention. We're going to have Medicare IRMA and understanding MAGI and controlling modified adjusted gross income. We're going to talk about required minimum distributions. We're going to talk about estate taxes, i.e. what happens when you die with your money. And then not covered, but some things that are important to always be aware of: property taxes, pre-65 healthcare subsidies are a big topic, withdrawal ordering, which is another video, and controlling your passive taxation, which is another video I created on withdrawal strategies. But, starting here with Social Security, if there's one area that I would say is very complicated for me to calculate on paper, it's understanding the interaction of Social Security once you do other things. And here's what I mean by that. If someone's just basically living on Social Security, they're usually in a 0% taxable situation. But as you take money from other things, IRAs, pensions, capital gains, you can actually run a situation where Social Security starts to become taxable to you. And it's not all taxable up front. It actually goes up by percentage. It might be only 50% taxable to you. It might be 85% taxable to you, which is the maximum. And so as you go through this grid here, as you make other decisions, it retroactively can change how your Social Security is taxable to you. And this is why I buy tax planning software, is just for this one problem right here, right? And so understanding that Social Security can be taxable for you, it's going to gum up a lot of your other tax strategies. It is one of the big reasons I try and get people to delay Social Security, so that I can do other tax strategies along the way, because it can be more difficult to calculate, okay? And so remember, the maximum Social Security can ever be taxable is 85% of the benefit at your tax bracket, right? So if your tax bracket's 12%, 85% times the benefit times 12%. Okay. I do suggest that you do withhold some taxes from your Social Security payments. I'm always worried about seniors getting a big tax bill, and especially when they're older and they can't, keep track of things as well, getting hit by that. So I usually suggest you go ahead and you withhold a little bit when you file for Social Security. And once again, interesting thing here about Social Security, and this is what I meant by you just living on Social Security income. Compare the left and the right column. Left column, you're taking money out of your IRA or 401k. The right column, you're taking money out of your Social Security only, right? This is a couple living on two Social Security benefits at $80,000 Social Security. You might say, well, that's a big number. What if you only have $50,000? Well, guess what? That's less income. Still 0% taxes. It actually gives you more room to do other tax strategies, in fact. But you'll notice here that there is this big difference in Social Security taxes versus your own individual taxes. And trying to maximize your situation here, taking money out tactically in the 10 to 12% bracket so that you can delay Social Security later and potentially pay 0% taxes, could be a very powerful strategy for retirees. Now, the other thing is you get a larger standard deduction. At age 65, it bumps up. Congratulations. So you just get more money tax-free out of the system. Kind of cool. Doesn't need an extra slide. It's that simple. Now, Medicare IRMA, I always remember talking to my mother-in-law, and she said, I told her, why are you worrying about Medicare IRMA? I mean, I worry a little bit about it, but in general, whenever you try and avoid Medicare IRMA, you're losing so much income to avoid it that it actually wasn't worth avoiding it if you want to go do what you want to do in retirement. And she said, yeah, but it's like a pinprick. I hate it. I hate that letter. I hate seeing it. It drives me crazy. I get that. And so Medicare IRMA is an idea that your Medicare Part B and your prescription drug coverage or your Advantage plan is tied to your modified adjusted gross income, or MAGI, right? So adjusted gross income is basically all your income, but a modified adjusted gross income is going to try and add in things like Social Security that wasn't taxable to you, and it's called MAGI. And that's how Medicare figures out what you are going to owe for your part of your premium. And it's a 2-year look back. So if you retired at 65 and you're on Medicare, unless you go file for the waiver, it's going to try and base your Medicare Part B premium based upon your last paychecks, not based upon your current situation. You should file for the waiver if you run into that situation. Okay. But when we talk about MAGI, there's this problem here. If you are going to live on, say, $140,000 a year, and you're like, dang it, I want to be on the lower MAGI calculation. I only want to pay $230 a month. Well, you need to lower your income by $18,000 roughly to fix that situation. That's $1,500 less a month for you to save $100 in effectively taxes here a month. That means your net overall, you're going to live on $1,400 less a month to go below your MAGI number. I don't think that's worth it for most retirees to live on so much less a month to try and protect themselves from this. Some people it is, right? If you're the person that their goal in retirement is to control taxes, and there's certain people that's their goal, I get it. I run into that. But really the problem we talk about Maggie is if you're close to $1 over, right? $1 over, and then you trigger this. So you want to know where your lines are, not because you want to necessarily control your retirement around Maggie. You just want to know if you're close to the line to prevent going over, basically. One of my first retiree clients I ever worked with was what I always call someone who's dirt rich. They were living on almost no money. They had, they were racking up credit card bills, but they had this rental property that their son, who didn't have a job, was living in. And I'm like, okay, so here's the problem. You're not generating income from this. You can't kick your son out. You probably need to sell this and, go ahead and pay off your credit card bills, generate income for yourself from the proceeds, and put yourself in a better financial situation because you're heading towards retirement failure. So they went through that route, and it worked. It fixed their retirement situation. And then I remember they came in almost screaming at me because all of a sudden they got this letter from Medicare 2 years later that they owe Medicare IRMA because they made a whole bunch of income that 1 year. And I had to point out to them that they needed to file for the waiver and see if they could get that waived. And even though it put them in a far better financial situation, that little pinprick of Medicare or Maggie, Medicare IRMA, is going to be really annoying for most retirees and something I'm very well aware of. So just understanding how Maggie works and understanding, avoiding going over this by $1 or $2, understanding how to file for your waivers if it applies to you, I think is really important for retirees to understand as a concept. So if this applies to you, you should look these things up and do it. Required minimum distributions. Required is in the name, meaning you're supposed to do this. It's once you turn 73 now, and you can actually make it so that you take 2 out in 1 year because you can actually delay your age 73 one a year over. I usually suggest don't doing that. More about tax bracket planning and being more tactical with your taxes than that. So I much prefer you doing the RMD in your age 73 year, not delaying till 4/1. But you can always look at it. There's always I'm never shocked that there's might be one niche scenario where it's better to delay it. But what happens with required minimum distributions, if you delay it to the future year, you're going to take a double required minimum distribution out. And required minimum distributions are always income taxable. So you've taken money out, which are the most destructive to your taxes, and you've doubled that situation. Hard to make that work. And it's a very simple calculation. You look at your 1231 balances, and you divide it by your uniform lifetime table factor, which the IRS publishes every year. And most of the time, you just use an online calculator. But remember, we're talking about required minimum distributions. It's based upon account type. So all IRAs you own, if you own an IRA, all IRAs can be used to satisfy the RMD. So you could take it from one account or all of them equally. But if you have a 401k and an IRA, you got to treat them separately. And that's why in retirement, I suggest people consolidate their monies down to IRAs if they can. Doesn't mean hiring an advisor. It means consolidating to IRAs so that you can simplify your required minimum distribution situation, and you have now the option to take required minimum distributions, RMDs, from any IRA to satisfy it all, not just each of them individually. The other thing we talk about required minimum distributions, it's in the name. It's based upon the balances. Most custodians, places that hold your money, will let you fill out one form one time. They'll calculate this for you, and they'll send the money exactly where you want. I usually suggest getting this money reinvested, okay? If you reinvest it, then what happens is you can still take the money out and spend it later, but as you get older, you might not be able to pay attention to your RMDs. You may not be keeping up on this appropriately. You might start having your money sit in cash for a very long period of time. So if you set up a reinvestment program that's appropriate for your risk tolerance, you actually kind of protect yourself from inflation, and you protect yourself from letting cash sit as you get older, which can be important. So try and automate this. I usually try and suggest reinvesting it. And remember, required's in the name. You're supposed to do it. The only way to you can't fix this once it starts. Really, the only way to fix it is tax bracket planning ahead of time. This is why I started this presentation with tax bracket planning. Ideally, when you're taking money out is in the 10 to 12% bracket and avoiding the RMD later. The problem with RMDs is they can do other things. It's not the RMD themselves. Required minimum distributions can oftentimes be very tax efficient. It's you taking out little bits of money over your lifetime. It almost on its own almost makes you attack your tax brackets on its own, just without trying. But that extra income can make Medicare IRMA pop on you. And all of a sudden you have that annoying Medicare IRMA on top of having to pay taxes and take money up. it can cause your tax brackets to go up and mess up other strategies you're trying to do. Your heirs, if they inherit the money, they actually may be in a worse tax situation than you are taking the required minimum distributions. And so you can always think about this. There's also one other problem when we talk about required minimum distributions. It can be very efficient dribbling the money out over your lifetime. But at end of life, you might have higher than normal medical expenses. And there's one other reason you may not want to be too aggressive attacking your required minimum distributions. You might not want to be too aggressive doing Roth conversions. Is if you have a future medical event that's very expensive, you get to start now itemizing, not using the standard deduction, itemizing and taking money out of your IRAs potentially tax-free at that point. So there's this other interesting component to required minimum distributions is where you want to attack your tax brackets early, but you may not want to be too aggressive because if you ever have, true medical expenses later in life, you might get the medical deduction that kind of makes your tax situation way better at that point. All right, so estate taxes. A lot of what we talk about is the process of taking money out and paying taxes and how it can affect different things. But, both federally and in the state of Washington, we have estate taxes, i.e. just your total balances that you might owe taxes on. And it can be a problem because, especially on the state level here in Washington State, couples don't get the marital deduction unless they've done planning ahead of time. What happens is the first person dies, the second person inherits it, does a basic filing but doesn't owe taxes. And then when that person dies, they have all the assets, the big pool, and then they get to go through the estate tax numbers. And, if you live in Washington State, if you look at your property tax values, so they've exploded, the average person is more and more often going to have to pay Washington State estate taxes. And when this law was put in place back in 2006, the exemption was $2 million. Now it's only around 2.2. And we think about how incomes, 401ks, property values have exploded in the state of Washington. Getting appropriate estate planning in place for Washington State estate taxes is important because, if you have an estate, say, of $3 million, you're going to owe $100,000 in taxes potentially in Washington State estate taxes. And there's two ways to really look at this. You might say, I believe in paying this tax, or you might want to believe in avoiding this tax. And to avoid this tax, you actually need to start doing things that lawyers in the state were terrible at for a long time. You start utilizing trusts in your estate planning documents. I remember when I first started in the financial services industry, remember this is over 17 years ago, I would talk to lawyers and they would talk about powers of attorney and wills, because Washington State has a really good probate system. And they were terrible at trusts. And they never did most of the federal estate tax things because once the federal estate tax limits went up so high that the average person never could sniff it, they just never dealt with it. And now I'm seeing lawyers paying more attention to bypass trusts, AB trusts, credit shelter trusts, things that were designed to deal with the federal estate taxes, now utilizing them in Washington State. So it's really been interesting watching the legal industry, how they've improved their practices based upon Washington State estate taxes. And the reason I mention that is if you have old estate documents, it might be time to pay that annoying fee to a lawyer and restate those at some point here. Because Washington State estate taxes is real. It's becoming more and more a problem for the average person, and you got to watch out for this. Now, I didn't go too much into federal. And the reason I don't go into federal is to get into federal, currently you have to have over $12 million per person of an estate. Less than 1% of people have that situation. And even when it goes down, because it's supposed to sunset, down to roughly 6 million, I'm using just big round numbers. It's not precision, but it's close. The average person still doesn't necessarily have that problem. 6 million per person, right? A couple, up to $12 million. And so, you have to have more than that number to start worrying about federal estate taxes. But if you are, it's the same basic process we talked about with Washington State. Now, we didn't cover everything here. We didn't cover property taxes, pre-65 healthcare subsidies, which is based upon your MAGI. We didn't cover, and I have a video on withdrawal ordering and controlling your passive taxation coming up soon. But there are other tax considerations to consider, but the entire point of this portion here was here's things you need to look at, and then you got to think, does this apply to me? And then dive in, right? Because basic tax bracket planning, right? Well, if you're just going to live on Social Security in retirement, there's not a lot of tax bracket planning you need to worry about, so it may not apply to you. If you don't have capital gains taxable assets, well, that section may not apply to you. There's lots of areas here that may not apply to you. But as we go through a basis overview, now you can go, well, it matters to me. I've gotten a 95% answer, hopefully. Now I need to dive in and really fine-tune my situation, if appropriate, right? And that's where we're here to help. We do tax planning, not tax filing. So if you want to put yourself in a better tax situation, consider bugging us. And, we run the Retirement Roadmap Program here for AAA, so, take a whole bunch of our time for free all the time. But, I'm happy to help, and I'm happy to just have conversations. This is the best part of my job, actually, looking at everyone's situation. So thank you, and I hope you look forward to the next video we have.